And risk, what is risk in finance? Uncertainty, yes, right? So here, if you read the definition of risk here, we're talking about another uncertainty, right? It's a possibility that actual cash flows from an investment will be different from expected cash flows, right? So that's another uncertainty here, right? So in businesses, in finance, okay, we can try to manage this kind of risk using certain techniques. Okay? There are hedging and non-hedging techniques in this chapter, right? And this first slide and second slide, if you look at it, right, they're talking about some non-hedging risk management strategies. Okay? And these are just some descriptive. They're talking about what the company can do. Hedging involves actually buying and selling the financial instruments, right? But non-hedging, if you look at this slide, acquiring additional information, of course, having more information always helps, right? Diversification and purchasing insurance and this kind of things, right? So if you read the chapter, I think you can easily understand. This is, I just made a summary of those concepts here in the first and second slides. So I'm not going to spend time with this. Just read the chapter and see if you can understand everything here. Okay? And we're going to go directly into hedging. Okay? Hedging strategies for risk management. Okay? First of all, what is a hedge? Okay? Hedge is the same thing as fence. Right? So it's very difficult to see this kind of thing in Seoul city. But if you go to a rural area, if you go to United States suburban area, they have this kind of shrubs, some plants to mark their territory or their boundary of their land or yard. Okay? And this is a kind of untrimmed hedge, and sometimes you can use a hedge trimmer to make it look nice like this. Okay? So these are what we're talking about, hedge. Hedge is the same thing as a fence, okay? Defending. Okay? All right, so what is a financial hedge? It's a transaction that limits the risk associated with fluctuation in the price of a commodity, currency, or financial instrument. Okay? So, when we say hedging, it simply means that you're doing something to limit your risk, or limit your loss in financial transaction, right? When you purchase stocks or whatever, getting into any financial transaction, right? You can actually do something to reduce or limit what we call downside risk, right? Downside limit. Okay. You can use forward, futures, and options. We're going to talk about these three kind of hedging instruments in this chapter today. Okay, forward, I think I mentioned it before. It's an agreement to buy or sell an asset at some point in time, which means forwards have what? Maturity or expiration. Okay? There is some expiration date or maturity date, okay, in the future at a specified price agreed to. Okay? What that means is a forward has what? As an exercise price or strike price. Okay? And when we discussed the option, we talked about exercise price or strike price. Okay? The same thing here. Yeah? And at the time the contract is purchased or sold. Okay? Okay, so, example, let's say, again, a lot of these financial instruments have their origin in the old agricultural society, right? So, using that agricultural example, Campbell soup, right? Campbell. Campbell Soup is a very famous, probably the largest soup manufacturing company in the United States. Okay? And they make all kinds of soups and all kinds of food, canned food. Okay? And if you look at, there are probably hundreds of different brands of or types of soup. Right? In every soup, you will find corn. Okay? Seems that they can't make any soup without corn, right? So, obviously Campbell Soup uses a lot of corn, right? So they need to ensure that they have enough supply of corn, right? All right. So they can get into a producer or farmer, right? Corn grower, okay? And get into a contract, say, 3 months from now. Okay? When the, let's say, corn harvesting season comes, okay? You're going to sell to Campbell Soup Company certain amount of corn at a certain price, right? So that's a kind of forward contract, right? So you can get into long position or short position. Okay? Long position means you are buying, you are purchasing, okay? And short position means you are selling. Okay? So Campbell Soup Company, obviously they are buyer of the corn, right? So they have a long position on forward contract. Okay? Farmers, on the other hand, will have a short position on the forward contract. Okay? They are the sellers. Okay? Okay, so we have delivery versus spot price. Delivery price is the same thing as exercise price. Okay? So on a certain day, they promise the supplier, farmer here, okay? Supplier or the person who took a short position on forward contract, okay? Promises to deliver this item at certain price, at a set price, okay? Agreed upon price. Okay? That's the delivery price. Okay? Spot price simply means the market price at that time. Okay? Spot price. Okay? Long versus short position, I already explained. And it involves performance risk. Okay? Because this forward contract does not have organized market. Okay? Something like CBOE, Chicago Board of Trade, CBOT, right? Or CME, or Chicago Mercantile Exchange. Okay? These are the mercantile exchanges where all kinds of commodities, corn, pork belly, oil, all kinds of things are traded. Okay? But forward contracts do not have an organized market. So the forward contracts are made between individuals. Individual company to another company, individual investor and another investor, something like that, right? And OTC, it is on OTC, over the counter. Okay? We call it OTC trading. Okay? So it's simply the contract between individuals. Okay? So when the time comes, let's say October comes, okay? And farmer may fail to deliver. They agreed to deliver, say, 10,000 tons of corn, right? But maybe the weather was bad, or there was some flooding or some plant disease, whatever, right? So the farmer may not be able to deliver entire 10,000 tons they have promised. Okay? So there is that's the idea of performance risk. Okay? There is nothing you can do about it. Okay? It's because it's an individual contract. Okay? And there is there is no organized market, I already explained. Okay? So the most common in the foreign exchange market. Okay? I believe. Yeah, here's an example of foreign exchange market posting or quotation. Right? Let's just spend maybe 1 minute on this. Okay? Try to understand. And on a certain day, June 18, 2010, these were the foreign currency exchange rates. Okay? The first column shows foreign currency in US dollar, okay, on Friday, okay, on this Friday, so this June 18. Okay? And so let's look at Canadian dollar. Okay? So what 0.9791 means, in order to purchase 1 Canadian dollar, you had to pay 0.9791 US dollar. Okay? This is a foreign currency in US dollar. Okay? Last Friday, 1 week ago, okay, it was 0.9673. Okay? So last Friday, you could purchase 1 Canadian dollar with only 96.73 cents of US dollar. Okay? But this Friday, it costs a little more, 97 cents, $91. 97.91 cents. Okay? Okay? So what does that mean? What happened to Canadian dollar as opposed to US dollar? Value went up, down. It went from 96.7 to 97.9. You have to pay more US dollars to purchase 1 Canadian dollar, right? Right. So that means Canadian dollar has become stronger or appreciated, what we call appreciated, right? Against the US dollar, right? And what that means is US dollar has what? Depreciated against Canadian dollar, right? Right. Here, the next two columns do it in opposite way. It says US dollar in foreign currency, right? So what that means, as of today, June 18, Friday, right? In order to purchase 1 US dollar, you have to pay 1.02, $1.02 in Canadian dollar, Canadian currency, right? Last Friday, it was 1.03. You had to pay a little more Canadian dollar to purchase US dollar. But it costs a little less today, right? So again, what that means is Canadian dollar has become a little bit stronger, right? And US dollar has depreciated against Canadian dollar, right? That's how you read this exchange rate, right? And then there are 1 month forward, 3 months forward, and 6 months forward. Okay? So what is it? So today it's 0.9789. Today's spot price is 9791, right? But 1 month forward is 9789, right? So if you want to purchase the 1 month forward Canadian dollar, okay? So in other words, who would purchase this thing? Think about it. Between exporter and importer. I think we used this example before, right? Suppose you're an exporter. You just shipped some amount of some product to, trying to remember, I think in US dollar, Canadian. This is how much you have to pay in US dollar to purchase Canadian dollar. Okay, so if you are a producer, manufacturer in the United States, Okay? Help me here. Who would need to purchase a forward of Canadian dollar? Importer in US. Okay, you are importing something from Canada. Okay, so 1 month later you have to make a payment, right? And you agreed to pay in Canadian dollar, right? Suppose you've just imported some items from Canada, right? Maple syrup, maybe, and you agreed to make the payment in 1 month in Canadian dollar, right? So 1 month later, you need to have, say, 1 million Canadian dollar. Okay? All right? So are you trying to, you're trying to hedge against what? Against appreciation or depreciation of US dollar? Which is good or which is bad? Which is bad for you? So right now you are in the US. You need to make the payment in Canadian dollar. You're an importer. Okay? Would you like to have appreciation of US dollar or depreciation of US dollar? Appreciation, right? In that case, you would like to have US dollar to become stronger, which means it'll cost less in US dollar to purchase 1 Canadian dollar, right? Okay? Good. So, so if you're an importer, right, you would think about purchasing this 1 month or 3 months forward, okay, in that sense, right? And actually what happens is right now it's 97.9, but 1 month forward is 97.89, slightly lower. What does that mean? Market thinks US dollar is going to appreciate within next month or so, right? Within the next month or so, right? That's why you have to pay slightly less, okay? To purchase 1 month forward, okay? Okay? You can agree with someone who has who holds the Canadian dollar right now. You're getting into a contract, okay? So 1 month later, I'm going to pay you. You're going to sell me 1 Canadian dollar at the cost of 97.89 cents in US dollar, US currency. Okay? All right. So that's the idea of currency forward. Okay. Well, if you expect to use Canadian dollar 3 months later, of course, you will get into the 3 months forward contract and so on. Right? Any question about this chart? All right. So, yeah, futures contracts, the forward and futures are very similar. Yeah? Very similar idea, right? The only difference is the futures are standardized contract, and they are traded on an organized exchange. Same idea as forward, okay? But instead of just individuals getting into certain contracts, say you agreed to sell me 100 tons of corn 3 months later at certain price, right? These corn futures are standardized in the, say, Chicago Mercantile Exchange, right? So instead of 100 tons, you can say every tons, or 25 tons, right? So each unit of corn future is, say, 25 tons, okay? Then if you expect to purchase 100 tons of corn, right? Then you can purchase 4 units of corn future from the market. Do you understand? Right? If you are dealing with forward contract, right? metric tons of corn, right? But if you can do the same thing using the future, right? And future market, you have standardized unit, standardized corn future, right? Let's say each unit is 25 tons, right? Then you can purchase 4 units of corn futures, right? To make sure that you have 100 tons, you can buy 100 tons of corn on the specific date, right? Okay, so, like some organized market like Chicago Board of Trade. Another famous market is NYMEX, NYMEX, New York Mercantile Exchange. Mercantile Exchange. Okay. CME is Chicago Mercantile Exchange. Okay. CBOE is Chicago Board of Trade. Board of CBOT, sorry. Board of Trade. Okay. Yeah, these are most famous organized market for these commodities. Okay. So you can purchase futures from these markets, okay, instead of getting into individual contracts. Okay. And that way you can avoid what? Performance risk. Right? These futures are guaranteed by this market, right, organized market. Okay? Okay, so same thing as future, delivery versus spot price, long versus short position, and performance guarantee, that's the difference. Right? Marking to market, what is it? Marking to market, that's an interesting concept. Okay? How do these organized markets make sure that the futures are safe, or the promises are delivered? Okay? That's by marking to market. Okay? Marking to market means gain and losses are settled every day or each day. When the market closes every day, right? Somebody loses, somebody gains. Trading, stock trading or whatever, option trading or whatever, right? These tradings are zero-sum game. If you gain some amount, that means someone else lost some amount, the same amount. Okay? That's the idea of zero-sum game, right? So let's say Campbell Soup company purchased future from this organized market, and then that means someone sold that futures to the market, right? Let's say ADM, Archer Daniels Midland, is the largest agricultural company, industrialized agricultural company, right? So this company owns a lot of land, agriculture, farming land, okay? And they grow all kinds of what? Grain and vegetable and all kinds of food items, okay? And then they sell it to the market. Okay? So here's, let's say, in the middle there is let's say CBOT, Chicago Board of Trade. Okay? And the thing is, Campbell Soup doesn't know who is providing this future. They don't have to know each other, right? Because ADM sells the futures to CBOT, or they write the futures, okay, on CBOT, right? Campbell Soup purchases futures from CBOT, right? But I mean, if they purchase the 100 units of corn futures, right? 50 might have come from ADM, another 50 might have come from another company, another farming company, right? Or whatever, right? So the thing is, they don't know each other. They don't have to know each other, right? All they know is they're doing the trading with the organized market, right? But each company or each individual have to have a margin account. Margin account. Okay? Every time you join the market or you want to start a stock trading, right? You have to open an account with say brokerage house, right? And they will open a margin account for you. Okay? So before you purchase any stock, you have to put some money in your account, in your margin account, right? All right. So let's say Campbell Soup took a long position at $3. Long position at $3. So they purchased, let's say, 1 unit of corn future, 3-month corn future at $3, right? Which means now Campbell Soup has a right to purchase 1 unit. The 1 unit may be, I don't know, maybe 25 ton or whatever, 20 ton or, right, of corn, right, 3 months later. And you can pay let's say bushel. Each bushel of bushel is about this big, right? Like bucket size, okay? A little big, large bucket size, okay? And say $3. They have the right to purchase 1 bushel of corn at $3 3 months later, right? And that means somebody agreed that, right? So ADM has a short position at $3. They agreed to pay, they sell 1 bushel of corn at $3 3 months later. Okay? But today, the corn market price, goes up and down, right? And today it closes at $3.05. It closes at $3.05. Okay? Okay? Then, what's going to happen is there is a margin account. It's called the margin account. Okay? Here I have to do it this way. Here's the margin, the Campbell Soup margin account, and here's ADM margin account. Okay. The 5 cents difference will be transferred not directly because they don't have direct relationship, but let's do it this way. 5 cents goes from the clearinghouse margin account. Okay? So 5 cents will be transferred from ADM margin account to the clearinghouse margin account, and 5 cents will be transferred from clearinghouse margin account to this Campbell Soup margin account. Okay? That's the idea of marking to market. right? Gain and loss are settled every day. Who's gaining and who's losing here, right? See, Campbell Soup is holding the right to purchase 1 bushel of corn at $3, right? No matter what the market price, no matter what the spot price may be at the time of expiration, right? They can purchase, they have the right to purchase the corn at $3, right? Because somebody else has agreed to sell 1 bushel of corn at $3, regardless of spot price, okay? But today, market closed at $3.05, right? So what that means is Campbell has gained because they can actually pay only $3 and receive the merchandise which is worth $3.05, right? The ADM has lost. That's a loss to ADM because even though the market price is currently $3.05, they have to supply that material or merchandise at $3, right? So why do we do this every day, right? If something happens, some disaster strikes, and ADM closes down tomorrow, right? Then Campbell Soup, the right will be guaranteed because right now the market price is $3.05. It costs $3.05 to purchase 1 bushel of corn, right? Campbell has agreed to pay $3, and now they have 5 cents in their account, right? Deposited by the clearinghouse, right? So, they can purchase, basically they can purchase $3.05 item with only $3 because they have 5 cents in their account, right? That's the idea of marking to market every day, right? Something happens today and the contract ends, the other party disappears, right? This party is still protected, right? That's the idea of marking to market. Okay, so that happens in the futures, and that's how the performance is guaranteed. So performance guarantee requires margin account. Each party has margin account with this organized market or clearinghouse. And the gain and loss have to be settled every day by marking to mark. Right? In Korea, have you heard of Yatagwon? Yeah, Yatagwon does that function, especially with the stocks and all the other things. It's an example of clearinghouse. Okay, so here are just an example of some future contract price. If you look at here, it says copper, high, CMX. I guess this high means high quality or high oxygen content, whatever. I don't know much about the copper, right? So this high means some quality, right? Because there can be some different levels of quality in the copper, right? And the symbol of that item is CMX, right? 25,000 pounds, right? So each unit of this future is 25,000 pounds of copper. So if you buy one unit, one future contract, that involves 25,000 pounds of copper. But the price quotation here, these numbers are cents per pound, right? So you can calculate the price of one unit, one future contract. That's going to be what? If you are thinking about, here's a settling price, 300.5 cents, okay? So if you're thinking about July 10th, today is today is July 15th. Oh, I'm sorry, this is July 2010, right? Right? So obviously there is an expiration date sometime in July, right? Okay? So July, if you want to purchase one unit of July copper contract, right? You'll have to pay what? 300.5, which is $3.50 times 25,000, right? That's going to be the price of one future contract, right? In this case, yeah. Okay, and down here you have gold. Okay, gold is, I guess gold is gold. Okay, there is no quality here, right? And GMX, that's the symbol of the gold. Okay, and one unit, one future contract involves 100 troy ounce. Okay, and the price quotation here, dollar per troy ounce. Troy ounce. That should be troy, not toy. All right? Okay, so that's how the futures are purchased and sold. All right, so let's talk about exact hedging strategies. How do you manage risk using hedges? Okay, hedging strategies. Okay. Long hedge example. Let's say a company, Halstead Industry, they anticipate the need for 100,000 pounds of copper in mid-December 2010. They, let's say, agree to produce certain products, okay? And they expect to use this much copper at that time, right? So they have three possible options. They can wait until December and buy the copper at the spot price or market price. Or they can buy the copper today and store it until needed. Okay? So what's the downside or risk involved with each of these strategies? Okay? Well, if you wait until December, price may rise at that time. Price may be very high. Or you may not be able to purchase enough copper, right? There may be some shortage of copper, right? And that means the price will be very high too, right? If you purchase the copper today, then you can avoid that problem, right? You don't have to worry about price rising, right? And you already purchased enough copper, right? But what's the problem with purchasing copper today? You have to store it. Storage, you need a storage space. Okay, and? What? Price may go down. Price may decline. And another problem is your money is tied. You've already spent money on copper unnecessarily because you don't need this copper until December, right? Today may be July, or yeah. So you've spent this money for the copper, and that means your money is tied for the next 5 months, right? Okay. The last strategy, last possibility, is execute a long hedge by purchasing the copper in the futures market for December delivery at the December future price. Well, here's an example. Okay? So here on the left side, we have cash market trade, right? So in other words, if you just do the cash trade without getting into hedging, right? You can do this, right? The idea is today's price, okay, is today's expected price for December is 303.3 cents, right? On December 15, let's say the spot price goes up to 320 cents, right? Then at that time, if you wait until then, you have to pay $320,000, right? So compared to the strategy of purchasing today, right? You're losing the money here, right? Because you have to pay higher price. Or you can do the futures trade here. Okay? You can purchase 4 units of 25,000 pound December futures at 303.3 cents per pound. Okay? So the total amount will be $303,300. Okay? Well, when the time comes, December 15, right? Spot price has risen to 320 cents, right? So what you can do is you're holding this 4 units of December future, right? You can sell those futures at the price, okay, at 320 cents per pound for a total of $320,000, right? So here you have to understand a couple of things here. So according to this story, on December 15, the spot price of gold is 320 cents. Okay? Then the future price will also be 320 cents. In other words, okay, spot price will be almost equal to delivery price. Delivery price at immediate maturity. Maturity, right? Think about it. Current, the copper price is 320 cents per pound. And here's a copper future that expires tomorrow. Right? So if you purchase this future, you have a right to purchase 1 pound of copper tomorrow. Tomorrow is the expiration day, right? How much will you pay for that right? Current market price is 320 cents, right? Would you pay much more than 320 cents? Right? Would you be able to buy this right at much less than 320 cents? No, nobody will sell you that right at 310 cents because we have just 1 day until expiration. You have to exercise it tomorrow, no later than tomorrow, right? And the current market price is 320 cents, right? So the spot price and delivery price will converge, right? They'll come very close, almost identical when the delivery day comes or expiration comes, right? Immediate maturity, right? So what this means is you're holding, even though you paid 303.3 cents when you purchased this December future, 5 months ago, that price has risen to 320 cents per pound. You can sell those futures in the market at 320 cents because current spot price is 320 cents, right? So you can use that money. I mean, what's the story here? Halstead, they are the producer of something. They use the copper, right? So they actually need 100,000 pounds of copper this month, maybe tomorrow, right? So you can sell. Why would they sell this future? I mean, future gives you the right to purchase copper, right, at certain amount, certain set price, right? Why do they sell that right instead of exercising that right to actually get the delivery of the copper? Here's the difference between forward and future contract, right? Forwards, you engaged in the contract between individual, right? So if you want a forward contract, you'll have to find someone who actually produces copper, maybe a copper mining company, right? And they have promised to deliver you 100,000 pounds of copper. Yeah? That's the forward contract. Future contracts, you don't know anybody. You did not find the copper mining company, right? You purchased this future contract from CBOT or NYMEX, right? So you don't know, you have no idea where the copper actually comes from. And nobody has actually promised you to deliver the copper, right, on a certain date, right? So what you're going to do is you're going to sell this future at expiration, and that means you have $320,000 in your pocket, and with that money, you can purchase the copper if you really need the copper, right, in the market, right? Doesn't matter who you buy from, right? If you really need copper. But actually, in most cases, they don't do that because those people who engage in this future trade are simply investors in many cases. They're trying to make money. They don't need copper, right? They have no use of copper, right? They just got into this trade because they thought copper price was going to go up, right? So that's why we're talking about profit. Profit in futures market is $16,700, right? You make money, right? You have no use of copper, right? So this activity here, we'll talk about that later, right? So that's what we're going to do that. All right, what else? Okay. So that's the idea of long hedging, right? You can hedge your risk by purchasing the future, and that was the hedge against what? Price rise. You could protect yourself, right, against the price rise, okay, by getting into long hedging. Okay. How about short hedge? Short hedge means you are selling the future contract. Okay? And how can you do that, right? Here's the actual copper producer, Battle Mountain Copper. They're a copper mining company who produces copper, right? And they have agreed to sell 50,000 pounds of copper, okay, in mid-November. Right? Well, what kind of risk do they have here? So here's an example here. oops, short hedge. Okay? Battle Mountain anticipates the sale of 50,000 pounds, and they expect to receive 302.65 cents per pound. Well, the risk is if the price goes down. Right? If the market price goes down, right? Previously, right? The risk was price going up, right? And they could protect themselves against price going up by getting into long hedge, right? And here, they agreed to sell it, right? But if the price goes down, then their revenue will be smaller, right? So they can get into the futures, okay? Instead of getting into a cash trade, okay? If you do the cash trade, then you have to sell the copper at 270 cents per pound, right? But if you get into the future, right, then you insured yourself, right, about the price, okay? So you have the right to sell each unit is 20,000 pound of copper, right, at 302.65 cents per pound, right? So, when the time comes, what happens? See what happens here. Battle Mountain sells 2 units of November future contract and receive $151,325 because they sold it. That was their sales revenue. Okay? When the November comes, actual price went down to 270, right? That means the future price or delivery price also comes down to 270. Spot price equals delivery price when the maturity comes. Okay? So you can actually buy two futures, right, at 270 cents per pound, right? It's called the offsetting trade or reversing. Offsetting trade or reversing the contract. Okay? So you have you have sold 2 futures. By purchasing 2 futures, you can reverse or offset your account, right? So in your clearinghouse account, everything is settled. Okay? You have sold, and now you have 2. You are holding. You purchased 2, whatever. Okay? So when you sold the future, you have obligation to deliver, right? But when you purchase the same item, right, you have right to receive, right? So that evens your obligation, right? And that's how you close the contract, right? And then if you do offsetting trade or reversing the contract, that contract is closed. Okay? And you just keep the difference. When you sold the 2 future, you received $151,000, right? In order to purchase the 2 contract and close the account, close the trade contract, right? You need to spend only $135,000, right? So the difference, $16,325, becomes your profit. Okay? in this story here, Copper Mountain, they actually need to deliver the copper, right? So what they can do is they can actually purchase the copper at 270 cents per pound and then deliver it to whatever, Halstead, who they sold the future to. You understand? Right? If they actually have to deliver the copper, right? Then using this future contract they just purchased, right? They can purchase actual copper and deliver it to Halstead if they really need to, right? But for if you are just the investor, you have no use of copper, right? You just thought the copper price was going down, right? So you took a short position in the beginning, right? In July, right? And in November, you can simply close the contract by offsetting or reversing, right? And you just keep the profit. Okay? All right? Sounds nice, okay? But there are some difficulties, right? Some difficulty comes from a few reasons. Okay? The available future contract sizes may not match the hedging needs of the firm. Right? In our example, there was a nice even number, like you needed 100,000 pounds of copper, and each future unit involves 25,000 pounds. So you could have purchased just 4 units, right, which is total of 100,000, right? But what if you need 90,000 pounds, right, of copper? Well, then what can you do? Right? So you have to maybe purchase 4 units of copper, right? But then you're going to get 10,000 extra pounds of copper, which you don't need. Well, I guess you'll have to do some calculation which one is better, right? Should I just purchase 3 units of future and purchase 15,000 pounds in the market? Or should I purchase 4 units of future? That means I'm going to get delivered 100,000 of copper, and I'm going to have 10,000 pounds of copper sitting in my warehouse, unused. Okay? So which one is better, right? Well, that means you can actually sell it in the market, in the cash market, right? 10,000 pounds, right? So yeah, you have to decide, right? There may be change in the relationship between the futures price and the local spot price. It's called the basis risk. And our textbook gives absolutely no explanation about this, right? It's a little bit complicated concept here. Okay? Slightly. Okay. Some commodities, like crude oil, have the delivery spot, delivery area, delivery location. Okay? For example, if you see the NYMEX crude oil, this morning there was a big news. Oil price is going down. So what, about 3 months ago, 2 months ago, it was above $50. This, as of yesterday, this morning, when the Western market closed, okay, it closed at below $38, okay, $37.70, right? If you look at, say, 2 years, yeah, look at this. Oh, come on. Slow. Okay, here. So about middle of 2014, actually 1.5 years ago. Right? It was above $100, right? And now it's about $37, $37.70, right? So here's a huge risk. If you are a company, airlines, for example, right? Airlines use a lot of fuel, jet fuel, right? But jet fuel comes from oil, right? So they are closely related, right? Changed together, right? Funny thing, when I was growing up in Korea, the biggest problem was oil price, because Korea doesn't produce a single drop of oil, right? It's 100% dependent on foreign oil, right? So when the oil price goes up, it's a huge problem to Korean economy. Right? When I came back 2 years ago, I saw a funny thing. Apparently SK is involved in refinery and re-exporting business. Okay? So actually they are making, even though we don't produce oil here, we are actually selling refined oil products. Right? So when the oil price goes down, it's not necessarily good for Korea now. I don't know why. Actually, I was at the party, what was it? Friday night, Saturday night? Yeah, Saturday night. Okay? My high school buddy, it was a high school sort of, my class reunion, right? And he's a vice president at SK, and he is involved in this funny business. He's mostly stationed in Peru, right? And apparently they are importing oil from Peru or South America, and refine the oil and selling all kinds of products to the world. So because of this drop in oil price, SK is losing a lot of money, apparently. Right? Anyway, so what was I going to say? It says crude oil, WTI, NYMEX. Okay? NYMEX, it's what we call NYMEX oil. Okay? And NYMEX oil has a delivery location of Louisiana. Okay? So this oil, if you really want to use oil, right, you actually have to go to Louisiana and get the oil delivered. Okay? The oil comes through Louisiana, these, I guess New Orleans, it's a harbor, it's a port. Okay? So the oil tankers come to this port, okay? And you have to get the delivery from that point. Okay? But let's say you are in Kentucky or whatever, Alabama, right? Then your local oil price may be different from this NYMEX oil price. Okay? That's what we're talking about here. So when you got into the future contract to hedge yourself against the oil price fluctuation, right? There was maybe 1-to-1 relationship, right? Your local oil price and the NYMEX oil price. Okay? But 3 months later, for some reason, when the NYMEX oil price went up or down by $10, okay, your local price did not go that much down or up, right? So the point is, it's sometimes difficult to match or hedge perfectly, right, against the gain and loss. Okay? And one of the reasons may be that location. Okay? It's called the basis risk. Okay? There may be a change in the relationship between the futures price and the local spot price. So you thought you were matching or hedging perfectly against the price change, right? And it happened in the NYMEX market, right? But your local price is different, right? So you still have to pay a certain amount or a little more than what you expected, right? That's the idea. Yeah? Okay. the airline industry, for example, right? They need to hedge the change against the change in jet fuel price. But there is no jet fuel commodity or futures, right? So what they do is they purchase or sell crude oil future, because jet fuel price and oil price are closely related. Okay? But they are not 100%, or they are exactly linked. Right? So there's another problem that's called the quality issue problem. Okay? Product quality issue. Product quality issue or risk. Okay? So sometimes you try to hedge against the price fluctuation of certain product, right? But that exact product is not available in future, so you do some closely related product like jet fuel and crude oil, right? But then that relationship may not be perfect, right? So that's the problem. Okay? All right, we have maybe couple of slides remaining, right? Yeah, option, basically the option, using the option to hedge. Right? We're going to finish this quickly on Thursday and go to the review session, okay? Any question? All right, see you on Thursday.